All right, what's up, everybody? It's Jeff and B-Rock back here from Smart Asset Capital. We are here to talk about our first full acquisition in SAC Industrial Fund 1. We're super excited about this deal. Just walked it today, and even more excited than we were when we originally bought it. This purchase is a 26,000 square foot flex industrial deal in Waukesha, Wisconsin that we bought for $1.5 million. The property was fully renovated in 2020. It's got ample outdoor parking and storage. The property has 15 tenants currently, with stable cash-on-cash yield coming in from day one and downside protection from the diversified tenant base that we have. There's upside potential, including renewing tenants' leases. We've got a lot of that to do. Expanding potential space with tenants. We're already starting to do that on day 7 of owning it, which is just fantastic. And to give you more context into the market, Waukesha County has been voted in numerous reports as the least vacant industrial warehouse space submarket in the country. That's the United States. That's a 0.8% vacancy rate. And, it's just crazy that we were there today and they're already asking for more space. And, it's funny to me that wasn't uncovered by the seller on the front end, but I understand why. The fact is development is contracting, it's limiting available space, and the high tenant demand supports rent growth over and above the national average. And that's something that we've talked about in other podcast shows and whatnot, where the Class B industrial space, small to medium size, has limited supply, and it's pushing rental rates up. To talk a little bit more about the purchase basis, we bought the property at $47 a square foot compared to the estimated replacement cost of $150 a square foot and the market average of $73 a square foot. So to break that down, we bought this property for 3 times less than what it would cost to build today. That's also in line with what our thesis for the entire fund has been, that we've been talking about for that. And it fits the industrial thesis as well, as just capitalizing on the reduced availability of industrial space and strong rental demand over the past 20 years. The property has 2 loading docks, 5 drive-in doors, and it underwent extensive renovations in 2020. The rent growth over the past year has been at 4.1%, which surpasses the 10-year average of 3.2%. So we're super excited about this one.
Yeah, to get into some of the business plan stuff, right? So we bought this property at a 76% occupancy rate. Our goal within 1 year is to take it to 90%, which is super conservative. Just to give you a little insight on who the seller was as well. I mean, this guy lives in a different country. The only marketing they were doing was he had a sign plopped out front. Yep. I mean, right when we walked the property today, we've been out there 5 times since we bought it. But
it's walking distance to our
It's right up the street from our office. So today we walked it we had 5 people in there, our whole team, and we introduced ourselves to each tenant. And just right off the bat, I mean, 3 tenants told us, hey, I want to rent that space across the hall. I haven't seen the owner in 6 months, or hey, this floorboard's been broken for a year. And I just think, they were super excited to see an active property management team in there compared to someone that's, it's a property once a year.
Especially right up the street.
Exactly. So it worked out well. I think we're going to add a ton of value to it right away. But specifically breaking down the business plan here is, within the first year, again, our goal is to take this from 76% to 90%. And I think that's very conservative just based off how the first week has gone. Also renewing leases, right? So there's a lot of short-term leases in here that have very below market rents. So our goal is to renew leases, get them on longer-term leases, and slowly increase those rents. Additionally, tax benefits, like always, we're doing a cost segregation study on this one. So we'll have a lot of great tax benefits for our investors. If we look at the underwriting specifically, we're maintaining a 10% vacancy rate through year 2 to year 7, which again, I mean, I think we have an opportunity to get to 100% occupancy here
in the next couple months.
Exactly. Also we have an extensive list of capital upgrades we're doing to the property, some roof upgrades, parking lots, some new flooring. We're going to rehab some of the units. So we have a list of stuff here to ultimately add value to the property and create a better experience for our tenants and attract new ones. Once we get through this, right, we're projecting it to take us 2 years to get through this. We'll be hitting a 10% cash on cash return to investors. And at that point, we'll start monitoring an exit, right?
Refinance, yeah.
Or refinance if rates come down. So our goal ultimately is to get cash back to investors as quick as possible. Cash flow and get you paid as quick as possible. So, year 3 to year 7, we'll be looking at the market and deciding when the best time to sell is. So that could be anywhere in that time range. Right now, if you look at the rent roll, there's $198,000 in gross income. We believe we can get that to over $270,000. So again, highlighting that opportunity to increase rents. There's 14 tenants in the building and 22 units total. Right now, the average current rent is $8.97 per square foot. We believe we can get the market, based on our market research, we can get the rents to $12.27 a foot. Our anchor tenant at the property, Prairie Farms. So it's a big dairy company here in Wisconsin.
If you ever been a Quick Trip, they're in there. Great
milk.
milk.
See them everywhere. So that's our anchor tenant paying the bulk of or the biggest on our rent roll. Highlight a little bit more on the numbers. We bought this property at an 8.2% cap rate. Again, we believe by year 2 we can get this thing to 11.3% cap rate. So there's over 300 basis points delta there. Again, we assumed a year lease up period. So in the pro forma, you'll see we assumed a year, but lease it up. Again, maintaining conservative underwriting. We think we're going to do it much quicker now, just based on how this first week went. Overall, if we look at returns perspective, we have 2 tiers. We have a gold and platinum tier. So on the gold tier, that's a check size of $100,000 to $300,000. It'll get you a 7% preferred return with a 70-30 profit sharing split, a 2% management fee. And then on the platinum side, if you invest $300K or more, you get a 10% preferred return with an 80-20 split and a 1% fund management fees. There's a pretty big delta there. And if we look at specifically what those returns are in each bucket, in the gold tier, you stand to make a 9.7% cash on cash return and a 2.5x equity multiple. Compared to the platinum tier, 2.75x equity multiple and 11.5% cash on cash return. So a pretty big delta there.
Yeah, and I would just say to highlight the conservative underwriting again, we just did our Q2 reporting. And as I was going through and writing up our quarterly reports, it was obvious to me that we're beating our pro forma for the most part across the board. There's a couple properties here and there that maybe we didn't have as great of a quarter and it didn't hit the pro forma numbers. But as you can see with underwriting assumed vacancy at 10% from years 2 to 7, we think we can be at 100% in this property within the first year. And that was apparent today. So if you're interested, we're looking to have conversations with equity investors. We are raising capital. We've got 2 other deals in great locations. The New Berlin Industrial Park, we're under contract for one there that might be the best industrial park in Wisconsin. Another one in Saukville, and we're actively looking to buy more deals and keep building wealth for our investors. And if you're interested, reach out to Brock or myself, Smart Asset Capital. And we look forward to hearing from you soon.
And as a reminder, accredited only fund.
Accredited only. Be great.